This lesson covers the average cost method for accounting for inventory. So we have our figures, and we're just going to take this information and we're going to identify and calculate the cost of goods sold and ending inventory underneath both the periodic, perpetual, and periodic methods or systems. So one of the first things we need to know is we definitely need to understand what's going on. Here in this section here, we'll have transactions. These are transactions for the month of July. A company that's a merchandising company is selling and buying their inventory products, and so we're going to keep track of what they sell and what they buy in this area here. On the first, they purchased 70 units and they paid $12 for those 70 units. They sold 250 units and they sold them at $20. So that's kind of what this information here means. We also say that they started with an opening balance of 500 units. And so under the average cost method, we would remember that what we do first is we calculate the average cost of inventory, and we use that average cost to calculate the value of the ending inventory and the cost of goods sold. We would start by looking at the average cost folder. The average cost formula, which is total cost of goods available for sale. Let's put that over here, and that'll be divided by total units available for sale. Okay, so let's just put a line there to signify that's dividing by. So that's a little makeshift formula area there. Okay, so based on this formula, we need to calculate the average cost underneath both the perpetual and the periodic system. Now, one thing we will remember with the perpetual system is always going to be more detailed and a lot more work, because following the notion of the perpetual system, after every transaction, we need to know the value. And so periodic usually tends to be much simpler than perpetual. So let's start with the perpetual, and I'll show you what I mean. With perpetual, we have to calculate this average cost formula on multiple occasions, meaning we need to calculate it every time we have a purchase or a sale. So let's start with the information. First, we need to know cost of goods available for sale, total units available for sale. Well, that means that after every transaction, we need to know what's the cost of the units available for sale and what's the total units available for sale. The cost, and let me just add a column here, because we actually need to know the value of these transactions. We know the units, the number of units, and we know the amounts. And so let's calculate the overall value. And so to calculate that, we'll take the units multiplied by the dollar value, and that gives us the value of each of the units, and we can do that going down. Hopefully we are familiar with Excel, because Excel helps out a lot in a number of these things, because I can just drag and it calculates everything for me. My opening balance, let's just say that my opening balance is worth $10. I forgot to give that a value. And so here we go. So this is the value of everything that we present here. What's important to also calculate is ending units, because that's going to be key at some point for all of the calculations. And the ending number of units is going to be pretty much us trying to figure out, or not trying to figure out, but calculating the adjustments to the opening balance as a result of things that are going on. So let's use a formula, and we're going to say it's equal to, we start with $500, and what's going to happen is we go from top to the bottom the first day until the end of the month. We have to add, we purchased 70 units, so we have to add those 70 units to our 500 units, because that's what happens when we purchase something. If we sell 250 units, that means we have 250 less, so I take away. Again, we're adding 50 units because we purchase more. We're adding 100 because we purchase more, and we sold 375, so we take that away, and that gives us ending units of $95. And the purpose of all of these calculations is we can have the 95 units, but how do we know what to place here as our value? We don't know. We don't know what the value is until we're able to calculate it. And so that's the purpose of using these methods to determine the value that we place against the remaining inventory assets. Because how do we know which one of these figures to choose? We can choose any one. Do we choose the first one? Do we choose the last one? Well, it can get tricky, and all of this helps us to understand which value is going to be selected. So let's get started with the average cost formula here. And in order to do that, we have to first determine, or let's go over these two terms. Cost of goods available for sale. We said that the cost of goods available for sale is based on the formula. Cost of goods available for sale, let's leave it like that. And the cost of goods available for sale is beginning inventory plus any purchases made. And that's considered to be our cost of goods available for sale. Because when you think about it, available for sale is what you have at the time that can be sold. And so that's the only way we would know what's available for sale. Now, this can apply to both of them, because one is just the cost of the actual goods available for sale, which is the value, and one is the units. And so this information here tells us the the value and the units. It's just that after each transaction, we have to recalculate that value. So let's start at the top, and we're going to start with what happened on the 1st. So on July 1st, what happened is we had 50 units that were available at $12. And so under the perpetual system, we're carrying everything down. So what we have to remember is, of the units that we have on July 1st, how many units do we have available for sale? Well, we said that we purchased 70, but that's not all that we would have available for sale, because the opening balance is also available. And so our units here is going to be 500 units plus 70 is what's available for sale. And now what we need to calculate is the dollar value. Let me just bring this down so it's clear what we're doing here. This is my units, and this is my dollar value, and then this is my overall value column. Okay, and so we have our 570 units, the 500 opening balance plus the 70. And now we have to calculate what the dollar value would be, because that's the only way we can calculate the value. Because remember, the value is a formula, units times the dollar value. And so what we do is we use this average cost formula to calculate the dollar value assigned to each unit, which is this area here. And so how we determine that is we say we have to take the cost of goods available for sale divided by total units available for sale. In order to calculate this value, well, we do know the value of this 570 is the 840 plus the 5,000 gives us the total cost of goods available for sale. That represents how much is left. And so what we do here is, let's just say, let's add up our value here. And the value is equal to 840 plus 5,000. And so to calculate the dollar value in the middle, what we need to say, we need to take equals to the 5840, which is the cost, divided by the total units available for sale, the 570. And that gives us $10.25 equals to this value of 5,840. What this is saying is that as of July 1st, we had 570 units available for sale, and they were valued at $10.25. And that brought the value to the 58,400. Okay? Note that these should always be rounded to 2 decimal places. From there, we actually have to move on. This is our balance as of July 1st. We have to move on to the next transaction. The next transaction happens on the 5th, which is a sale. So let's put July 5th there. And what we have to do now is account for the sale. So the sale is for 250 units. And I'm going to put this in as a negative to remind us that it's a sale. And it reduces our units. So that's minus $250, 50 units. So in this instance, what's the value of these 250 units? We don't know the value of this units. Keep in mind, this $20 here is the sales price, because we don't have a value for each unit that we sell. That's the purpose of the calculation. So we actually are calculating that. So underneath the average cost perpetual method, what happens is we take the last average cost that we calculated and we apply that to the units that we're selling. So in this instance, we last calculated average cost at $10.25. And so therefore, $10.25 is the cost we assign to these 250 units that were sold. And so we can calculate the value of inventory that was sold by taking our units times the dollar value assigned. And this is the value of units sold. As it's perpetual, after each transaction, we should know how many units are available, and we should know the value of those units. And so that's why also I put that in brackets, because it's easier for me to calculate. So what this is saying is, after the 5th, I have 320 units that I have left over, and I'm valuing them at $3,277.50. So that means that if I was to prepare a balance sheet as of July 5th, this would be the amount that sits as on the balance sheet underneath the asset section as my inventory. That's the purpose of all of this. So let's continue, because we have to get through to the end of the month. This happens on a month-by-month basis. And so we need to finish all the transactions for the month in order to get to our ending inventory. And so we're now on the 6th. So let's say July 6th. On July 6th, what happened is we purchased an additional 50. So I'm going to leave that positive. And we purchased them at $10.50. $10.50. And the value of that is equal to, well, we have that over there, the 525. And we have that at 525. What we do next is we have to calculate the balance. So after every transaction, we're calculating the balance. The balance in this case is equal to the sum of, or the total of these two, and the total of these two. This gives us the balance that's in the account after that transaction occurred. Okay. And so next, what we still have to do is we have to find out the average cost. The average cost, again, is going to be equal to the sum of the total cost divided by the total units available for sale, $10.28. I actually left it off here, but we would do the same thing up here. The 3,277.50 divided by 32.50. Sorry. Okay. And so those would be my values that I'm bringing down. This average cost, if you notice, changes every time a transaction happens. Now, the only thing that's not calculated is when we make purchases, because we know what the cost is of the purchase, but the average changes after every transaction. The average was $10.25. So what I'm going to do is I'm going to put this in blue so we can see that was the average calculated, $10.25. Then we calculate the average at $10.24. The average is now at $10.28. Okay, so let's just continue using the same process again. This is July 16th. July 16th has 100 items were purchased, and they were purchased at $14. And the value of those 100 items purchased, 100 times the 14, gives us $1,400. And so after this transaction now, we need to figure out what is the value of our inventory that's on hand. Well, available for sale after the 16th is now 470 units, 370 plus 100. And then the value of that is now $5,202.50. If we calculate our average cost again, the value divided by this over here, we get $11.07 is now the average cost as of the 16th. We're getting there, we're getting there. Now, the last transaction is the 30th, which is July 30th, the last thing, which is a sale. So we sold 375 units. So let's take that away, minus 375. We sold them for $20, but now we need to know what the value of these items sold is worth. Like I say, what we do is we take the exact average cost that we just calculated. 1107 would be the value that we assign to these assets sold, these inventory assets sold. And so 375 times 1075 gives us 4,151.25 is now the new value that's associated with the sale. And so we now have to add these two up again, the last balance plus the new change, and we see that we get 95 units. 95 units. And the sum of this over here is we're saying that these units are valued at $1,051.25. If you pay attention, you'll note that we came right back to our $95, our ending units. So we should know that we're on the right page. By doing all of this, what we did is we calculated our ending inventory balance, because our ending units is 95 units. And we're saying that the value of this 95 units based on perpetual system is $1,051.25. And so we actually can put that as our value, really. That is the value of our ending inventory under the perpetual system. Now, what else we're supposed to be calculating is our cost of goods sold. And if you remember, the transaction for cost of goods sold, oops, got my D, got the D, cost of goods sold, highlight these, bold, cost of goods sold, the formula for that is cost of goods available for sale minus ending inventory. And so that's how we calculate our cost of goods sold. So let's see what we know. The cost of goods available for sale minus ending inventory. Our ending inventory we know is $1,051.25. So how do we determine our cost of goods available for sale? Well, under the average cost perpetual system, we actually don't need to calculate the cost of goods available for sale because it's perpetual, we calculated our cost of our goods sold after every transaction. And so that's different from what's going to happen for the periodic. If we look at it, we already calculate the cost of our goods sold each time we sold something. So we calculated that the 250 we sold was valued at $2,562, and we calculated that the 375 sold was valued at $4,151.25. So that then means that our cost of goods sold is actually going to be equal to this amount here plus this amount here. And I can take out the negative because it's not negative anymore. And our cost of goods sold is now calculated at $6,713.75 because we just added these two numbers here to get us our cost of goods sold. And so this is the perpetual method.